What is the best way to use stop losses to manage positions when trading options? This is a very, very open-ended question because there is not a best way. It's whatever way you prefer. There's a couple of different ways that you can do this and manage your risk on options. Neither one is right or wrong. It really comes down to what you like better. Two different ways to do this. Set a stop loss based on the actual price of the option contract itself, or set a stop loss based on the price of the underlying stock, the option you're trading. There's pros and cons of each. Setting your stop loss based on the price of the option will allow you to manage your risk completely, where you say, I'll buy this option at $5. If it gets to 420, I'm going to stop out. That way you'll know exactly how much money you're going to lose if you're wrong. That's the pro of that. The con of that is you might get stopped out of your position just because your timing is off. So even though the underlying stock, the pattern is still intact, time decay, IV crush could eat into the premium on your contract, stop you out of the position, and then the trade may end up working itself out. So those are the pros and cons of that. The other option you have is setting your stop loss based on the underlying stock itself. So let's say if you get into SPY put options at 390 and you say my stop loss is if the SPY gets to 393, that's you saying I'm in this trade as long as the SPY is under 393. I'm in the trade. Doesn't matter if it's 10 minutes from now, if it's 5 hours from now, you're in the trade. The pro of that is as long as the chart pattern of the underlying stock is intact, you'll be in the trade. The con to that is you're going to lose a different amount of money depending on when you get stopped out of that trade. If you get stopped out of that trade in 10 minutes or in 5 hours, you're going to lose a completely different amount of money because of IV crush and time decay. Those are the two different ways for you to do this. If you're going to do it based on the underlying stock itself and not based on the price of the option, or it doesn't matter, either one, make sure you check your delta on your option contract. Your delta value in your option will tell you how far the option will move for every $1 move that the stock makes. So if you have a delta of 0.4, that means if the stock moves $1, the option will move 40 cents. And that can help you kind of gauge where the option may be if you do get stopped out, but that's not taking into account any IV crush or time decay. So I always will tell people when you're trying to do it that way, if you figure out, if you say, okay, my delta is 0.4, if you buy an option at, let's say $6 and you got a delta of 0.4 and your stop loss is $2 away, then your delta would be 0.4 times $2 is your stop loss. So you're looking at 80 cents. So if you buy the stock at $6, you're looking at $5.20 minimum, but that's not factoring in time decay or implied volatility. So give yourself a little bit of an extra buffer, call it $5. And that's how you can give a guesstimate and say, okay, my stop loss is around $5. So now you know kind of a ballpark, how many options I need to buy at 6. So if I do get stopped out at 5, I'm within my risk tolerance. And that's just a quick little calculation. Again, it's not going to be exact, but it's a quick little calculation that can help you guys kind of figure that stuff out. I hope that helps, John.